everyone. Welcome back to the course on International Financial Management. In our previous two lectures, we developed a theoretical foundation for understanding exchange rate movements. We started with purchasing power parity, which was linked with exchange rates with inflation and price level across countries. We then moved to Fisher effect and the international Fisher effect, which introduced the role of interest rates and explained how difference in nominal interest rates across countries are closely linked to differences in inflation and expected exchange rate movements. Now, if you think about it, both PPP and IFV were fundamentally about spot exchange rates, the rate at which currencies are exchanged right now, that is today. But here is something important to think about. In real world, not all currency transactions happen today. A company that imports machinery from the USA may need to pay in dollars 3 months from now. An investor placing funds in foreign country wants to know when I can bring my money back home after a year and at what rate. A bank lending in one currency and borrowing in another needs to plan for future cash flows. All of these situations involve the future, and that brings us to a very important concept, the forward exchange rate. The rate agreed today for a transaction that will happen at a future date. And the theory that tells us exactly how forward exchange rates are determined and whether you can actually earn profit by exploiting interest rate differential across countries is what we study today. This is the interest rate parity theory, or we can also call it as IRP. IRP is a bridge between interest rates and forward exchange rates, and it is one of the most practically useful theories in all the international finance. Let us begin. So, what exactly does interest rate parity say? Interest rate parity states that in an efficient financial market, the difference in interest rates between two currencies should be equal to the expected change in the exchange rate between those two currencies over a specified period. In other words, if the US offers a higher interest rate than the UK, the advantage should be exactly offset by the expected movement in the exchange rate. The dollar, which attracted capital because of its higher interest rate, should be expected to depreciate relative to the pound by roughly the same amount as the interest rate advantage. The core postulate of IRP is simple, that is, interest rate differential is equal to forward rate differential. When these two are approximately equal, the market is in equilibrium. And as we will see shortly, it is arbitrage, the activity of profit seeking investors that forces this equality. The forward rate differentials measures the difference between the forward exchange rate and the current spot exchange rate as a percentage of the spot rate. In simple terms, it tells us whether a currency is trading at a premium or discount in forward market compared to its current value in spot market. Forward rate differential is equal to F minus S upon S into 100. If the forward rate is higher than the spot rate, the foreign currency is said to be at a forward premium. If the forward rate is lower than the spot rate, the foreign currency is said to be at a forward discount. When these conditions hold, that is, when the interest rate differential equals to the forward rate differential, there can be no profit to be made by moving money from one country to another. The extra interest you earn in the high rate country is exactly cancelled out by the unfavored forward exchange rate you lock in when bringing your money back. And this is why IRP is so powerful as a framework. It tells traders and investors at a glance, is there a genuine arbitrage opportunity here, or has the market already priced everything in? Equilibrium under IRP is reached when the difference between the forward exchange rate and the spot exchange rate closely matches the difference in the interest rate between two currencies. Think about what this means practically. If the US interest is 2% higher than the UK interest rate, then under IRP, the forward rate of the dollar should reflect a discount of approximately 2% relative to its spot rate. The dollar is worth more today than it will be in forward market, precisely because investors are already pricing in the expected depreciation that comes with higher inflation and capital inflows. Now, let us look at the mathematical expression of IRP, the forward rate formula. The forward rate is determined as forward rate is equal to spot rate into 1 plus domestic interest rate divided by 1 plus foreign interest rate. This formula tells us exactly what the forward rate should be for IRP to hold, that is, for no arbitrage opportunity to exist. When the domestic interest rate is higher than the forward interest rate, and the forward rate will be higher than the spot rate, it means more domestic currency will be needed to buy 1 unit of foreign currency in future. Therefore, the foreign currency is at a forward premium. The foreign currency will appreciate and the domestic currency is expected to weaken. When the domestic interest rate is lower than the foreign interest rate, the forward rate will be lower than the spot rate. This means fewer units of domestic currency will be needed to buy 1 unit of foreign currency in future. The foreign currency is now at a forward discount. Therefore, the foreign currency depreciate and the domestic currency is expected to strengthen. In both cases, the forward rate adjusts to neutralize the interest rate advantage. The formula is not just theoretical, it is actively used by banks and traders every single day to price forward contracts in the foreign exchange market. Higher interest rate in country attract foreign investors because they can earn better returns there. To invest, they must first buy that country's currency, which increases demand for it. However, if investor could earn both a higher interest rate and also avoid any loss from exchange rate changes, everyone would keep moving money there to make risk-free profits. To prevent this, the forward exchange rate adjusts. A country with higher interest rate will usually see its currency trade at a forward discount. So the extra interest earned is offset by an expected fall in the currency value. The discount keeps growing until it exactly offsets the interest rate advantage. At that point, the extra interest earned in the US is completely cancelled out by the unfavorable forward exchange rate. No profit remains. Arbitrage stops. Equilibrium is restored. This is why IRP holds. It ensures that investors cannot make unlimited arbitrage profits simply by moving money across countries. The self correcting mechanism driven by rational investors and arbitrage is the entire rationale behind IRP. Now, there are two distinct forms of interest rate arbitrage, and understanding the difference between them is very important. These are covered interest rate arbitrage and uncovered interest rate arbitrage. Let us start with covered interest rate arbitrage. Covered interest rate arbitrage occurs when the forward rate differential is not equal to interest rate differential. In other words, the market has not yet fully priced in the interest rate difference in the forward market, that is, forward rate. A gap exists, and the gap represents the profit opportunity. The key characteristics of the covered arbitrage is that the investor uses a forward contract to lock in the exchange rate for the conversion back into the home currency. By doing this, all exchange rate is completely eliminated. The profit, if the opportunity exists, is essentially certain and risk free. Now, the process works like this. First, you borrow in the low interest rate currency. Then you convert those borrowed funds to the high interest rate currency at the current spot rate. You invest those funds at a higher interest rate, and crucially, at the same time, you enter into a forward contract to sell the high interest rate currency and buy back the lower interest rate currency at a rate agreed today. When the investment matures, you complete the forward contract, repay your borrowings, and pocket the difference. The profit is difference between what you earn and what you owe. This process continues. More and more arbitrageurs doing exactly this process until the forward rate adjusts sufficiently to eliminate the profit. At that point, the forward rate differential equals to the interest rate differential, and the covered interest rate arbitrage is no longer feasible. Now I'll explain to you the covered interest rate arbitrage with help of an example. For example, we have been given the following information. The interest rate in India is, let's say, 18%, while interest rate in US is 12%. Now, the spot exchange rate, that is the current rate, is equal to 80 rupees, and the forward rate given to us, which is a 90-day forward rate, is equal to 80.56 rupees per dollar, right? This is the exchange rate given to us. Now we have to find whether there is an arbitrage opportunity or not. To find whether there is an arbitrage opportunity, first we are going to calculate interest rate differential, and we will try to find whether it is equal to forward rate differential. If interest rate differential is not equal to forward rate differential, it means that arbitrage possibility exists. So, how we are going to do it? We know 1 plus RD upon 1 plus RF minus 1. This whole equation is equal to interest rate differential. We have been given interest rate at per annum basis. Now we will convert it into 90-day basis. So, our RD will be equal to 18% divided by 4, because we have to go for 90-day, that is 3 months interest rate. So, here this comes out to be 4.5%. Now, we will calculate the RF, which is equal to 12% by 4. This gives us 3%. Now, putting in this equation, we have 1 plus 0.045 divided by 1 plus 0.03 minus 1. Now, our interest rate differential is equal to 1.5 Now the next thing that comes is we need to find out about the forward rate differential. We have been given these rates, this is the spot rate and this is the forward rate. Now we know the forward rate differential is equal to F minus S upon S into 100. So here we have 80.56 minus 80 upon 80 gives us 0.007. So here 0.007 here means 0.7%. So here in this case we see that interest rate differential is greater than forward rate differential and hence the arbitrage process can happen, and in the arbitrage process what we have to do is we have to take the advantage. And what is the advantage here? The interest rate advantage. Now how are we going to take this interest rate advantage? The steps that we are going to do here is we will first borrow in USA. Let's say we borrow $1,000 and we will borrow it at a rate of 3% for 90 days. Now how much amount we have to pay? The amount that we need to pay is amount to repay this dollar loan will be equal to 1000, which is the principal, plus $30 which is our interest. So this is going to be 1030. Now first we have taken the dollar loan, right? And the dollar loan that we have taken is 1000. This prepayment we are going to do at the time of maturity. So this $1000 loan is going to be converted into the rupees, and this is going to be 80 rupees because this is the spot rate given to us. So we are doing it at the 0th period. So what are we trying to do? We are trying to take the advantage of the interest rate differential, and since in India the interest rate is high, we are going to invest in India and we are going to borrow from USA where the interest rate is low. So here what do we get? We get here 80,000. Now this 80,000 is going to be converted, this 80,000 is going to be invested at a rate of 4.5%, and the value, this is the investment that we have made, 4 into 4.05, which gives us 83,600. Now this is the money that we have got from investment, fine. So this is the total investment plus the gain in terms of interest that we have received. Now this thing will be now converted into dollars at forward rate. So what are we going to do? We are going to convert, and this we will do is 83,600 now divided by the forward rate. The spot rate is 80 rupees and the forward rate given to us is 80.56 rupees per dollar, right? So we are going to convert at this forward rate because after 90 months we are doing it, and the forward rate that we have been given is 80.56. So this is, we had already entered into a contract for this particular rate. Now the value that will be given to us is 1037.74 dollars. So the total earning is in dollars is how much? 1037.74. And how much we have invested? We have actually borrowed the money for investment, and the total amount that we have to pay at the time of maturity is 1030. So we will subtract the repayment, and the repayment is 1030 from the above, and the total profit that we have made due to arbitrage is $7.74, and these dollars we have earned on the investment of $1000. Now let us turn to the uncovered interest rate arbitrage. Uncovered interest rate arbitrage is fundamentally different in one crucial way. That is, there is no forward contract. So we do not enter into any forward contract, and hence there is no forward rate. So the investor does not hedge their currencies from exchange rate exposure. Instead, they make a bet. They form an expectations about the future spot rate. They on the basis of the inflation, and they act on that particular expectation. The process is similar to covered arbitrage in the early steps. You borrow in the low interest rate currency, convert to the higher interest rate currency, and invest at the higher rate. But when the investment matures, instead of executing a pre agreed forward contract, you simply convert back it to whatever spot rate happens to be at that time. If your expectations about the future spot rate was correct or better, you profit. If the currency moved against you more than you expected, your profit shrinks. And if it moved badly enough, you could actually make a loss. This is why it is called uncovered. Your position is exposed, unhedged, open to the market. Now I will explain to you the uncovered interest rate arbitrage with help of a numerical. Now we have got the following information. The interest rate in India is, let's say, 6% per annum, and the interest rate in USA is 5% per annum. Now the spot rate that we have got is, we'll take the same thing, that is 80 rupees per dollar, and now we don't have a forward rate, we have an expectation. So we are expecting that the rupee is going to depreciate because the interest rate is higher in India. So the expectation, the expect the rupee is expected to depreciate. So the expected spot rate is equal to, we are expecting rupees to depreciate, and the expected spot rate after 1 year is equal to 82 rupees per dollar. Now here again we are going to find out whether the arbitrage process can exist or not. For that, what we will do, we will find interest rate differential and the spot rate differential. Fine, that is the expected spot rate. Now let's first find out the interest rate differential. Now here we are taking the time span of 1 year. So we are taking this per annum interest rate. So here it is going to be, the interest rate differential is going to be RD 1 plus RD 1 plus RF minus 1. And here we are going to check the spot rate differential, which is equal to the expected spot rate minus the current spot rate upon the current spot rate. Now here what we do is 1.06 upon 1.05 minus 1. This is equal to 0.0095, which is equal to 0.95%. Now we are going to find it for the spot rate differential also. So this was interest rate differential, and now we will find the spot rate differential. Here what we have found out is the expected spot rate is 82, the current spot rate is 80 divided by current spot rate. So this comes out to be 0.025, or we can write it as 2.5%. So in this case we have found that the spot rate differential is greater to the interest rate differential. So we should take the advantage of spot rate rather than interest rate. Now let us do the process. In the process, though we know that the interest rate in India is higher than the interest rate in USA, but we are not going to take the interest rate advantage. We will take the spot rate advantage, and hence instead of borrowing from USA, we will borrow from India. Borrow in India. And how much? Let us say we are borrowing rupees 10,000 at 6% interest rate, fine, which is per annum interest rate. Now, when we borrow, what is going to be our repayment? The repayment amount is going to be 10,000 into 1.06, which is 10,600. That means here 600 is the interest rate. Now we will convert this 10,000 borrowed amount first, because this will happen at the time of maturity. That is after 1 year. So at the 0th period, when we borrowed this amount 10,000, we will invest in USA. For investing in USA, we have to convert it into dollars, and we will take the current rate. What was the current rate? Current rate was 80 rupees. So here we will take 10,000 divided by 80 rupees, and this gives us $125. So we are going to invest this $125 investment in USA at a rate of 5%, because here we are trying to exploit the spot rate differential. So this is equal to $125 into 1.05, which gives us $131.25. Now this dollars that we have got from USA are now be converted into rupees, and we know the rate. Suppose the spot rate is what became what we expected, and the spot rate was $1 is equal to 82. Then what we will do is, this spot rate is after 1 year, and it is as per our expectation. So we will multiply $131.25 into 82, and what we are going to get? We will get 10,076.2.5, that is 1,762.5. Now how much we have to pay for the repayment of the loan? We have to repay our loan, and to repay our loan, the amount required is 10,600. So here if we see, we have made a profit of 162.50 rupees by exploiting spot rate differential, because this were more advantageous for us. Than interest rate differential. Let us now place covered and uncovered arbitrage side by side so the distinction is completely clear. In covered arbitrage, a forward contract is used and the exchange rate risk is fully eliminated. The profit, if an opportunity exists, is certain. Arbitrage stops when the forward rate differential equals to the interest rate differential. In uncovered arbitrage, no forward contract is used. The exchange rate risk is fully retained. The profit depends entirely on whether your expectation of the future spot rate turns out to be correct. Arbitrage stops when the expected change in the spot rate equals the interest rate differential. One is the science, certain, calculable, risk free. The other is more of an informed bet, potentially profitable, but exposed to the unpredictability of markets. Now, let us understand the interest rate parity theory with help of a graph. Now, here if you see, in this we have a x-axis. In x-axis, we have the forward rate. From 0 to infinity, we can say, we have a forward premium. And in the minus quadrant, that is in the negative side, we have a forward discount. So here we have a forward premium and here we have a forward discount. Similarly, if we talk about the y-axis, we have interest rate differential. Now, interest rate differential here is IH minus IF, where IH is the domestic interest rate, that means the interest rate of home country, and IF is interest rate of foreign country. Now, we are going to discuss the various points that are in the graph. We have points A, B, C and D, which are falling on the IRP line, which is at a 45-degree from the axis. Now, here the points A, B, C and D, they are lying at the IRP line, which is the equilibrium state. So, at this point, let us say C, here C, the forward rate premium is 1%. Forward rate premium is equal to 1%, and the IH minus IF is also equal to 1%. So, here any advantage of the interest rate differential is offset by the forward rate differential. So, hence no arbitrage process can take place at the points A, B, C and D. So, we can see here the forward rate differential exactly offsets the interest rate differential. No arbitrage opportunity exists. Indian and US investor earns equal returns regardless of what they invest. Now, let us see the points below the line, right? We have 2 points below the line, in fact 3 points here. We have y point, m point and x point. Let us see one by one. Now, if we see the y point, we will find out that here the IH is greater than IF, that is interest rate at home country is greater than that of the foreign country, By how much amount? By 2%. Fine. So we can draw here 2%. While there is a forward rate differential, this is the forward rate differential. Approximately, this forward rate differential is equal to how much? Is equal to 4%. Fine. So, Indian investors benefit by investing in US because dollar, if we say here, forward rate differential means if it is a forward premium, then we can say the foreign currency, which is dollar here, because we are taking the case of India and dollar, India and USA. So, foreign currency, which is dollar here, is appreciating. And it is appreciating by 4%, while the interest rate in India is greater than the interest rate in USA by 2%. So, obviously, the forward rate differential is greater than the interest rate differential. And hence, Indian investors benefit by investing in the US and capital flows out of India to US. Now, let us take another point, which is X here. Now, in this X, we will find here X. X, we will find that there is an opposite condition in which the interest rate of the foreign country is greater than the interest rate of the home country, because here it is lying in the quadrant where y axis is negative. It is having a negative value. So here the interest in foreign country is greater than interest in home country. But if we see, then the forward rate differential is equal to -1. So here the US dollar is also depreciating. So here the interest rate differential is greater than the forward rate differential. So Indian investors gain 2% net by investing in US. That means the interest in USA is greater than interest in India by how much? By only 3%, and dollar depreciates by 1%. Still, we have an advantage of investing in USA. Now, let's talk for the point M. At the point M, if we see, we have a forward premium here. At point M, the IF, that is the interest in USA, is greater than the interest in India. Fine. By how much amount? By 4%. While the forward rate differential shows us the forward rate premium. Forward rate premium is 3%. We can see it from here, is 3%. And the interest rate differential, in which the interest rate of USA is greater than interest rate of India, is how much? 4%. And when I say forward rate premium is 3%, that means dollar is appreciating. In this condition, both the forward rate and the interest rate actually point us to the fact that investing in USA will be a better option. because the interest rate of USA is also high as well as the dollar is also appreciating. Now let's take the point Z. The Z point, if we see, the interest rate differential is 1%. That means, and here also the interest rate of USA is greater than interest rate of India by how much percent? By 1%, right? By 1%. I am talking about this point. Got it? So here, and if we see what is the forward rate differential? So here we see there is a forward rate discount, which means that the dollars are depreciating by 3%. So if we see that the advantage in investing in US is not high or it is not there. Why? Because the interest rate, though the interest rate of USA is greater than interest rate of India by 1%, but at the same time the dollar is depreciating more proportionately, and it is depreciating by 3%. So there is a net disadvantage of investing in USA. Now let's understand the point G. Now in this point G, we can see that IH is greater than IF, that is, in home interest rate is greater than foreign interest rate, and how much it is greater? It is greater than 4%. But if we see about the discount rate, that is the forward rate differential, which is a forward discount. So here there is a forward rate discount, and this is equal to 5%. So here if we will see that the home interest rate, that is the interest rate of India, is greater than interest rate of USA, and at the same time the dollar is depreciating. The interest rate of India is how much? 4%, is greater than in interest rate of USA by 4%, and dollar is also depreciating by 5%. So whether it is IRD, that is interest rate differential, or it is FRD, that is forward rate differential, both are going against the investment in USA. So it is better to invest in the home country. So we can say that the points which are lying below this IRP suggest that we should invest in the foreign country, while the points which are lying above the IRP line suggest that we should invest in the home country. Now let us talk about the deviations from IRP. So far we have been discussing IRP as though it always holds perfectly, but in the real world, like PPP and IFE before it, IRP does not always hold exactly. Let us understand why. The first reason is transaction cost. Every currency exchange, every borrowing, every forward contract comes with a fee, that is bid ask spreads, and sometimes taxes also. Those costs eats away the arbitrage profit. A theoretical profit of 0.5% may sound attractive, but after the transaction cost, it may be zero or even negative. So the arbitrage that enforces IRP simply does not get triggered when the profit is too small to cover the cost of the trade. The second reason is capital controls. That is, IRP requires that capital can move freely across borders. But some countries impose restrictions on how much currency can be converted, how much can be invested abroad, or how quickly funds can be repatriated. When these restrictions are in place, the arbitrage mechanism is blocked and IRP can deviate persistently. The third reason is market sentiments and speculation. Exchange rates are not always driven purely by fundamentals. Sometimes fear, greed, geopolitical events, or simply herd behavior can push exchange rates away from where IRP would suggest they would be. These deviations can persist for shorter or longer periods depending on how strong the speculated forces are. And we should also mention political risk and differential taxation. Investors in foreign countries face the risk that the government crisis could restrict currency conversion or that the tax rules could make a pre tax profit become a post tax loss. These factors add uncertainty and prevent arbitrage from fully enforcing IRP. Finally, the inflation differential. If one country has significantly higher inflation, its currency tends to depreciate. And this depreciation may not be perfectly captured in the forward rate, leading to deviations in IRP. And now, let us step back and see the complete picture because IRP does not stand alone. It is a part of a unified framework of parity theories, namely PPP, IFE, and FE. They together explain how exchange rates are determined. IRP connects interest rate differentials to the forward rate. Together, these four theories form a beautiful, coherent, interconnected framework. They all carry the same fundamental message. In efficient market, there are no free lunches. Arbitrage enforces equilibrium. When you look at the goods prices, inflation rates, nominal interest rates, or forward exchange rates, they are all connected. And rational market participants ensure that no persistent, risk free profit opportunity survives for long. This is the essence of international financial theory. And it is a framework that every student of international finance must carry them. Thank you for your attention today. I look forward to seeing you in the next lecture.